Hi, I'm Alex Miller, and this is the Citi Institute podcast, where we explore the forces shaping finance, the global economy, and the way we live and work. In each episode, we bring you insights from thought leaders and innovators driving change, helping you stay informed, navigate challenges, and seize opportunities in a rapidly evolving world.
Build the trust, build the transparency, so you can have open discussions and debates and dialogues.
You really have to pick the right partner at a later stage. You really need a capital provider that, when things don't go your way, will stick with you, right? In the later stages, because things always do change.
Welcome back to the Citi Institute podcast. The journey of fundraising for companies, from venture funding to IPOs, involves distinct stages with specific goals and challenges. Today, we have two exceptional guests joining us: Kelly Ahuja, the CEO of Versa Networks, and John Collmer, Global Head of ECM Private Placements at Citi. Together, we'll be exploring this critical journey of fundraising for companies at various stages of growth. We'll uncover the strategies, considerations, and key decisions that shape a company's financial trajectory. Settle in for what I promise you will be a fascinating discussion as we dissect the fundraising landscape from a corporate perspective. Whether you're a seasoned entrepreneur, a corporate executive, an interested investor, or simply curious about the world of finance, this episode is packed with valuable information you won't want to miss. So, let's dive in. Kelly, can you walk us first through Versa Networks' fundraising journey, highlighting key milestones and challenges that you had?
Sure. First of all, thank you, Alex, for having me here. Great to be here with you and John. Versa was founded back in 2012 by Kumar and Apurva Mehta. I joined them 4 years later. By that time, they'd already done 2 rounds of financing through traditional Silicon Valley-based venture capitalists investing in the company. After I joined, I think we've done about 4 rounds of funding since then. And our timing's been quite interesting. The first one was clearly when we didn't need the money, and a strategic came in and said, I want to invest because I want a seat at the table before in line with my commercial relationship with you. And following that, we went off to doing our Series D, E, and F. We were very pleased to work with Citi on our Series D raise. And had a very interesting timeline for that, but I'll go through that too. Our Series D timing was interesting. It was right before the start of COVID. In fact, our diligence process was over Zoom in virtual sessions. The Series E was actually in 2022. And when we started the raise, the environment was looking quite good. But during the raise, the environment changed. And that was around probably about this time in 2022, right, John? Is when we were kicking things off.
That's correct.
So we had to kind of adjust as we kind of went through it. And our last round, Series F, which we've just recently closed, was really something, again, where we didn't need the cash, but we had someone knock on the door and wanted to have a conversation. That led to a very quick process that we ran independently, and were able to close that successfully as well. So we've had an interesting journey around fundraising over the last few rounds, and got some nice stories to tell and share.
Well, that's a fantastic way to kind of kick us off. Maybe, John, I could bring you in early here and just remind us what your role is here at Citi, how you help companies. But from your perspective, what do you think are sort of the key trends and dynamics in what we call the private placement market?
Thanks, Alex. So my responsibility is I lead our global private placement efforts here. So it's a global team, one of the largest, one of the most established. So we're fortunate to work with companies like Versa. In terms of the trends, it's really interesting. We went through a period where everything was FOMO. Now we have JOMO, which is the joy of missing out. And so people feared missing deals. Now they have the pleasure of waiting is the point there. But the market remains very healthy, with a Q2 snapshot, late stage deals. These are deals greater than $500 million. That represented almost 60% of the market in Q2, going back since like 2024. So it's powerful. That's telling you investors have capital. They really want to invest behind late and mid stage, like Aversa. Those are where companies have really demonstrated product market fit and what I call advancing their go-to-market motion. You haven't mastered it. That doesn't mean you have to sit there and wait until every like card has been flipped, but you've advanced it. So that market, so think like mega deals, 500 million or kind of like 250 million in size or greater is very attractive. One last data point, growth capital, which is kind of 50 million in size of a deal up to 500 million, still on average is doing about $10 billion per month. So think of that. 10 billion in capital is being raised between 50 to 500 million, but the average deal size now is $265 million. So it is the later mid stage that's driving that, not the $50 million deals. So very confident in the market. It's all about that. Can you prove that you can take capital and make a solid return? And Kelly will talk more about it, but that is where the market is really focused right now.
And presumably, John, that reflects a shift away slightly from some of that earlier, less proven stage of the journey. Is that because of where rates are and some of the experience of the last few years?
Yeah, I think cost of capital has just got high on the investor side, rightfully. I mean, for every dollar you deploy, you have to have a higher degree of certainty that you can generate the return for your LPs, right? And so, yes, rates have played a factor there. But also, I think there's been a real light shined on companies and boards around what is your strategy and can you execute? And I think that is just a healthy like governor in the market now. And so quality is prevailing, and those companies like Versa are attracting that capital. So I think that bar got higher just globally on it, and it's a healthy thing.
Well, let's take that to Kelly. When you think about different funding options that the firm has had at different moments, whether it's venture capital, private equity, debt financing, how have you historically thought about that in terms of the pros and cons of each?
Yeah, and every step of the way, there's been some different options. I mean, you didn't mention SPACs, but even that was a fashionable thing not too long ago. For us, when we did our math and analysis, and just kind of based on our knowledge and experience, we always felt that venture capital was the right way to go. But you also have to find the right partner at the right stage. So it's not just about the money, but it's about the quality of money and the quality of the partner that you can engage at the right time, and for what reasons. So we've always gone with venture capital and gone through at every stage, looking for the right sort of investor with the right terms at that time to provide the right quality of investment.
Well, maybe we could sort of pull on that thread there in terms of for yourselves what that right type of investor profile was, and obviously it won't be the same for everybody. What would you be looking for beyond the capital itself?
At every stage, early on, it was more about the brand of the investor. So Sequoia was, really in our Series A, and post that we had to get the right sort of type of investors from a venture capital, and we primarily focused on Silicon Valley because the founders, their network, and everything else was around here. But as we started to grow and establish ourselves as a global brand and a global company, we needed to kind of get out of just the Silicon Valley traditional investment houses and get into a broader audience from a capital standpoint. And that's where Citi really helped us because they were able to put us on a pedestal alongside some of the large players that actually get a chance to surface around the global stage with marquee names from an investment point of view. So we were able to get BlackRock as an investor from the right fund, which was really focused around growth and innovation, which was a perfect time for us, and the right brand as we started to think about where the company needs to go. And along the way, the same thing has happened for us, which is we're looking for someone that can come in and partner with us and get us onto a few things, which is one, help us with any things that we need when we need them, not when we don't need them, but really kind of expand our aperture from whether it's go to market or opportunities that we may have from a growth standpoint, whether it's geographic or category wise, and bring us perspective from other things that they're seeing. So that's where, we kind of focus on the quality of investor. And we have, a few investors that are constantly introducing us into opportunities with CIOs and CISOs of very large global companies that sometimes we wouldn't have had access to, or organizations we wouldn't have access to around the world. With some of these, our partners, investors, actually have business development teams that focus solely on that and really kind of connecting their portfolio companies with their network of IT organizations or security organizations around global landscape. So those kind of things really help us and really structure kind of a nice engagement for us.
Maybe, John, from your perspective, when you're bringing the investors to a company like Versa Networks, what are the key factors that you think investors are considering when they evaluate the range of private placement opportunities? And of course, they're not all looking for the same thing.
That's right. And I kind of can use this also to reflect on when Kelly and I were partnering around this capital raise. Is it was really a shift in the market, and it's held is this: you're at 100 million, and what will it take to get you to 500 million, right? And before it was just, if you were in a big TAM, we'll believe that you can get there.
That's a total addressable market size, yes.
That's right. Yeah. So, prior to the Fed raising rates and people thinking about their cost of capital, it was just, if it's a large total addressable market or a TAM, we'll just give you credit that you can go and achieve and hit your milestones. Really now it's, can you get to that 500 million magic number? Why do I bring that up? That's largely where a company has multiple exits. They can either sell or they can go public, right? The bar for an initial IPO is.
And that's a top line revenue number, is that right?
That's right. And that is largely in growth stage companies. That's when you do your initial public offering or the IPO, that you're going to be judged on, and a multiple of your revenue will be applied. Well, before, like I mentioned, you just got credit for it. Now it's, let's unpack that, right? And this goes back to, where's the money going to? And have you built the team to do it? And we all forget in our microeconomics class the whole relationship between capital and labor. We are back in that market where investors are really like, I know I can give you capital, but from a labor and management standpoint, have you put this team in place to execute? Right. And I think that's what Kelly and the team has done really well. And Kelly will talk about his background. But when he came to Versa, he had put that in place. Right. And so we benefited Citi as his partners. He was already kind of pulling those levers internally, and we were able to demonstrate that. One thing that we realized quickly as a team is, growth rates were changing. People had an expectation of 50+% when we were starting the raise, meaning the investor was like, I really want to see you growing 50%. Within months of our fundraise going in, we started to hear, you know what, 30% is okay. And so we, as a team, and this took a lot of leadership from Kelly's standpoint, because a lot of founders want to just, and CEOs want to just kind of stick with what they thought was like their strategy was, let's go and take a 30% growth view. And what would that mean for a need of capital? And what would our profitability look like? And that really, I think, made us stand apart. I mean, this raise was done. This was the only raise done with a mutual fund that year and for another 6 months. That's how challenging the market was. When you're really looking at the investors right now, that's a huge consideration: is how do you going to get to that top line? What is the team in place to do it? And is there a management team there that's credible and can deliver?
Yeah, and John, just to add on to that, we went from growth at all costs, right, to a growth with a path to profitability, kind of during that raise. But the other thing was the amount of inspection, right, that was happening primarily around, hey, it's not just about how much money you're spending and go to market, but how efficient is it? There was a whole dynamic change, Alex, that happened through the process that we had to adapt, and that was really helpful with the partnership we had with Citi and John and his team. That was really able to debate that with us and just kind of adapt our thinking and our strategy around that process.
Interesting. Maybe we could just pivot and you could perhaps give us, Kelly, a sort of 60,000-foot view of what it's like perhaps when you're a founder, CEO, or shortly after founding, and you're kind of having that direct back and forth with the VC firm and you're kind of the single decision maker, as opposed to, as you've grown, as the revenues have grown, you've got a deeper base of investors, an established board. How's that fundraising conversation go? Is it more about internal alignment as you evolve and grow?
When you're starting off, right, whether you're a founder or a CEO founder, you're the king of the hill. You have to make all the decisions. You have to weigh all the pros and cons in your head or with your trusted a set of advisors. But as you grow and the company gets to later stages, you've got other stakeholders involved. So that internal alignment has to be there. But more importantly, you also have to align with your existing investors and ensure that whoever is going to come in is going to have the right mix. And more importantly, now you've got to, if you're using a partner to do the fundraise, you've got to align with them as well. Build the trust, build the transparency, so you can have open discussions and debates and dialogues. So that takes time. And it's something that you consciously have to invest in. So, for example, when we were doing the raise with Citi, it was a later stage. We were doing our Series E. We used to have a lot of internal alignment discussions between the founder, myself, CMO, CRO, and CFO. But once we had that, we had to then kind of had that discussion with the board just to make sure that our current investors are also aligned with us or get their feedback or input. But then also we had to have Citi at the right time and the right dialogues, whether it was just with us or us and the board, kind of get involved. And then Citi would manage the process, provide us guidance, and then we would have the conversations with potential investors. So there is a lot of conversations you have to do, a lot of brainstorming and thinking and planning and modeling and looking at the results and looking and adjusting, right? But that's got to be a very, very important part of the fundraise as you go through it. You don't kind of wake up one day and say, let me talk to investors. There is value in kind of starting the journey early, having a network, having trusted advisors, but also a portfolio of potential folks you want to go to raise money. So you've always got to be having those conversations. It's something that the CEO has to invest in and the CFO and the founder have to kind of invest in on an ongoing basis. You know what they always say, raise money when you don't need it. Well, I would tell you that talk to potential investors even when you don't need it, because when you need to raise money, you'll know who to call and you'll already have a relationship established and you would have already educated some of the folks on your model, on the business, and it won't be a fresh start for them.
When we met Kelly and we started to talk about, the fundraising, there were parties that he had met in the past and he gave us a license to go have initial conversations. And that came across very loud and clear. It was like Kelly and the team had left lasting positive impressions with them, and they were eager to come in and do work. Which, look, in large, that allowed us to create competitive tension, which every process does require. But more importantly, the credibility of the team was already established. But you really do need to build that partnership. That's an important aspect.
Well, maybe, John, I could ask you just to kind of evolve that point which Kelly was making at different points of a company's life cycle. Perhaps the requirements differ. Obviously, there's some commonality building relationships, but is there anything you would observe at different points of a company's life cycle that companies should be thinking about?
Yeah, I get this question a lot is, really what you're asking is like, if you're at different stages, is it different? And it is. And I think the earlier you are, you really need to, one, bake in time to raise the capital, not just your own personal time and the team's time, but you need to be raising when you don't need money. And we've learned that post, kind of 2021, 22 is we really encourage our clients is let's not view this as go hire Citi today. Let's think about who can you be meeting now, right? And Kelly and I still do it. There's a lot of investors that I've met, bragged about Versa, and then connected Kelly, and he continues the conversation on. And then I see that investor again, and they tell me, "Oh, I spent time with Kelly. That's an amazing story. Keep me posted." You really have to be doing that, especially when you're in an earlier mid stage. And then as you get later stage, you're building that time in, is what Kelly mentioned, is because you really have to pick the right partner at a later stage. It has to be you've stood up the business, you're scaling it. You really need a capital provider that when things don't go your way, will stick with you, right? In the later stages, because things always do change. And when you're making that adjustment, they understand it because they've seen your process and how you run the business, and that this isn't really a knee-jerk reaction. So I think regardless of it, is you're putting the time in. Earlier, it's you're putting it in because you need to get validation, right? Because diligence is the same, right? People are going to go pull the model apart. They're going to talk to your customers. Earlier stage, they're really trying to figure out the credibility of you and your ability to like put a team together. Once you put that team together, like Kelly had, it's more of him finding the right partner who will stick with the company regardless of what happens, and then also finding those other future partners.
Yeah, I agree with John. Basically, phases change from a kind of a technology and team stage in the early stage companies to a product market fit, right? To a mid stage company, to really diving into the model, right? At a later stage company. So you need to be prepared for all three stages with different sort of evidence or whatever you want to call it, right? For the diligence part.
That's fascinating. And maybe, Kelly, I could ask you there. What other advice would you give to companies either embarking on a fundraising journey or kind of, trying to improve the experience that they've had to date?
Well, my advice to any company would be, be open, be aware, and also engage. Engage when you don't need it. So keep the conversation going. Continue to spend time, carve out time, as John said, to really kind of go get to know the people beforehand, establish the relationship, educate people on the company, the space, the market, and the business. And what it really does is kind of makes it easier when you have to go raise the money because you've already got that network established. You've already got, and even look for partners when you don't need it, right? John and I have continued to talk, even though our fundraise was what, John, in 2022, right? Stayed in contact, and we always kind of catch up whenever the right time is there, and really kind of talk about the environment changing and what's going on, and even our needs are changing. So John's had us with our equity capital markets group and other things as well, just because we're evolving our business as also. So I think that investing in the relationship building, investing in educating potential investors and partners is absolutely fundamental to what you've got to do. And don't think that you can only do that when you need to start raising. Do it when you don't need to start raising because the process is going to get a lot more structured, and you're going to have a very defined process where you can run it. And that's where Citi really helped us, is really defined a structured process and ran it within a well-defined window of time to get to a decision. John talked about FOMO and JOMO, right? You want to have that period where you want to give the potential investors a window. Otherwise, you can be doing it for a long period of time, and there will be no close, right? So I think you really have to have that structure in the process, and that's where partners like Citi can really help.
And John, I mean, you must have spoken to and advised many companies and many investors in this process as well. Are there kind of common pitfalls or mistakes that you've seen from a company perspective, or indeed an investor perspective, that frustrates and you wish that that might have been avoided?
Every raise is different, but I think there is a common thread of unrealistic timelines, right? On both sides, you're a company, you've been managing your capital, you decided it's time to go, and you want to do it in 12 weeks, right? That's like the recipe for just disaster at that point because you are now dating whoever you meet. And so you're having to accept if you do get a deal done, you did not spend enough time with that investor to really understand them. They definitely didn't spend enough time if they had known you to learn your business, your superpowers and possible kryptonite. Be preparing when you don't need the capital, meeting people, which is a theme that we keep talking about, and then going into it knowing that you're going to have to invest the time. And that time for some raises can be 16 weeks or 20, and some it may have to be longer, and making that adjustment if needed, and not viewing it as a failure, viewing it as it's an evolution to the process to get to the right outcome. And that outcome can be what any objective. It could be finding the right partner, maximizing the right valuation that works for everyone, or just giving the investor a little bit of time to see the business evolve, which you've promised, right? And now they can see it, which, you know, we all want to like get in and get out, but we're not in that. It goes back to people are fine missing deals now. And so if you run it too fast, you end up getting everybody to sit back versus lean in. The other thing is trying to take every dollar off the table, right? And this isn't a banker saying, "Hey, I'd love to get you a deal done with a low value." It's just look, my background. When I started, I used to do all the IPOs, right? And I covered the largest mutual funds, the Fidelities of the world, and I would always ask those portfolio managers, what allows you to stick with this company if things haven't worked out? And they said, one, the person didn't take every dollar off the table going in, and I learned the business, right? And so there was this mindset of nobody dies from dilution. Let's find the right partner. And so if you do that right, and you don't take every dollar off the table going in, and you start the partnership on a positive foot, you're able to then have somebody you can call throughout and talk about versus I've overpromised so much. I maximize dollars to the nth degree. I don't feel comfortable expressing what's going on yet, right? So it creates this protective environment versus an open, inclusive environment with your founders. With your investors. So I feel like it's a balance of don't be in a rush, do it right, measure twice, cut once, and then also land in the right place where everybody felt like they got a very fair deal.
At different stages, what's fair for the company or the investor might change. So you have to be flexible, Alex, as you mentioned, and adaptable to the environment. And you have to know what's important to you and what's going to be important to the investor, and then find the right path, right? And we've always felt that again, the quality of money, the quality of the terms, not just the valuation, but quality of the entire terms matter. So that's where you've got to look at all the perspectives as you make the decision.
That's fascinating. Maybe, John, you could just walk us through the pros and cons of private placement specifically as one of the fundraising options.
Yeah, I think the advantages of private placements is that it's private. It's done in confidentiality. It's not like you're out in the public market, talking about your fundraise and people. You can make adjustments or you can choose not to do a deal without being penalized. The other thing is your information is shared confidentially, so you're not having to like divulge that to everyone. Competitors don't see it, customers don't see it, right? And so there's huge advantages to that as well. Um, some of the cons, it used to be just straight equity, so the cost of capital would be more expensive because you had one, it was an illiquid investment for the investor, meaning they've invested but could not get liquidity until either a big secondary happened or an IPO or M&A. If you're a minority investor, that's typically done, when the company or the broader board is ready. So there was always this trade-off of, what is the right cost of capital for that illiquid discount. That has changed and we can talk about, but that is something you have to think about if you stay private and you're doing private raises. As you go through and work with these investors, they are making that trade-off of a dollar into Versa versus a dollar into another company, right? There's trade-offs between and that's a decision investors need to think about. From a positive standpoint, you really do get that time to build your relationship with the investor. You get time to evolve your business model, right? A strategy is great, but opportunities do come up that allow you to expand on that strategy. And as a private company, you and your board and the investors and advisors can really think about that versus, in other markets where other people can see, you have to then respond to the reaction. The last one is your employees can only see the headline value, right? They don't have to watch the value change every day, right? And so as long as you are a long-term strategic thinker like Kelly and the team, and you're building equity value longer term, the employees receive that benefit, but also only see it at the time of the raises versus every day in the stock market.
Well, I'd love to kind of pick up that point, Kelly, with you, because of course, a lot of what a management does isn't necessarily visible both to employees, but also externally. How do you think about managing that balance between securing the funding when you want to get it and that maintenance of control over the company's vision and direction? Because there must be an intrinsic tension at points in a company's life on that.
Well, there's never a dull moment when you're,
I'm
kind
sure.
of out running a company because there's several aspects. I mean, even now, right after I finish this, I'm going to get on a customer call or many customer calls today, as well as other internal calls. So there's lots of going on. So you have to kind of balance and manage your attention and focus. But all the things are important. When you're raising capital, that's really important. And you've got to find the right balance on how much time you invest in it versus other areas of the business, and you have to have the right team to be able to rely on if you do have to spend time away from the day-to-day operations to go focus on diligence or other things that you have to prepare for. But the other thing is having the right support system, whether it's the board or the new investors. Both are critical because the board, the investors that you have today on the board, if they believe in you, if they believe in you as a management team, believe in the business, and you're delivering results, they're going to let you operate the business as you want, right, as you need, and give you that independence. And you want that to be the way that you want to run the company. You don't want the board to run the company. You want, as a CEO, you want to run the company. As a management team, you want to run the company. And that's really important. And even when you look for investors or potential investors or partners, you have to find the right ones with the right mix and the right sort of balance that'll allow you to do that. So that also is part of the consideration when you look at raising capital.
From day one of taking in the capital throughout your relationship with that board member or series of board members, because that trust is formed over time. So when you're in a fundraise, having that trust, it's important, right? Because everyone is definitely aligned and have fiduciary duties for the company, but they still have animal spirits, right? And so, they want to generate the right return for their fund and their shareholders that are LPs. So having that relationship to be able to talk through it and get everyone aligned, that's done through years of trust. And, you see it in boardrooms when that hasn't been built. It's a much more challenging environment.
And John, maybe I could just ask you to leave us with a few comments around how you see that private placement market perhaps evolving in the future, what implications that might have for companies seeking capital.
It's been a really interesting past few years because we talked about the start of this around the growth capital that's being formed still really at significant levels, right back to pre-COVID levels. But what we didn't talk is like there's these really cheaper cost of capitals funds that have shown up, right? Where they're able to do hybrid solutions. So a company that's later stage that says, I don't necessarily need equity like capital at the moment. I need capital, but I don't need either a board member or an operating partner. I just need money to keep fueling this growth, but I don't want to pay 30 cents on the dollar for it or 30% cost of capital. I'd like something in kind of the 15%, right? And so that didn't exist. And that's why I think you're seeing these, companies stay private longer, right? These very large companies out there 10 years ago would have gone public already, but now are, $30 billion tech private companies, but they're tapping traditional debt markets and hybrid. So I think that is changing for the benefit of companies and boards. It takes an education process. I was in San Francisco last week. CFO confided in me. He's like, I grew up in FP&A. I grew up in venture as a CFO. We have never done these. I would like to learn what these are because I'm hearing it, right? And this reminds me of 12, 13 years ago when we were doing the first crossover rounds with a mutual fund, and people were like, John, what does it mean to take money from a Fidelity, right? A Franklin Templeton. But now everyone knows that, right? And so I think we're in generation one for CFOs and CEOs to learn this. And I think it's exciting if done properly. That segment of the market is growing rapidly. Because what's happened is private credit funds are raising and getting approval to go into these hybrids. And so that capital is permanent and it was there and it was always there. It's not like it'll go away. And it's these companies aren't moonshots that are just burning capital, right? So they're going to do really well and outrun the return. So it feels like a very healthy evolution, which I'm really happy and excited to be a part of.
Well, that's fantastic. Kelly, any last sort of comments or thoughts or advice you would share?
It's not about raising money, waking up one day and starting the process. It's the art of planning for it, art of staying ahead of it. Again, invest time, build the relationships, build your network when you don't need the money, and then partner with the right firm to make sure that you're running a structured process. And continue, in sales, they always say, always be closing, in a founder's or a CEO's life cycle in the venture world, always be raising, right? Even when you don't need it, is what I would tell you. So continue to build that relationship, build a network, invest in it, make time for it, and it'll help you as a founder, but also it'll help you or a CEO establish a credibility in the market, but also expose the company to potential other customers, which is always what you're looking for.
Kelly, John, it's been a fascinating discussion and really truly grateful for both of your time. Thank you both so much. I'm sure we'll get lots of interest in everything you've been saying. So many thanks indeed.
My pleasure.
Thank you, Alex. Thank you for having me here.
Citigroup, Citi and Versa Networks are not affiliated and are independent from each other, though Versa Networks has a client relationship with Citi through Citi's banking and international business. The speakers' views are their own and may not necessarily reflect the views of Citi or any of its affiliates. All opinions are subject to change without notice. Neither the information provided nor any opinion expressed constitutes a solicitation for the purchase or sale of any security. The expressions of opinion are not intended to be a forecast of future events or a guarantee of future results.